Investments, part one. First of all, I'd like to talk a little bit about asset allocation. Oftentimes when you read in the media or talk to financial planners, they say that asset allocation is by far the most important part of investing. Well, it is very important, but I think that how much you save each year is definitely more important. And any of the academics will tell you that. For example, let's say that you have $10,000 a year to invest, and you put it in a really efficient fund, which is say 75% stocks, 25% bonds, so the risk level isn't too high, but you have a really superb portfolio, versus someone who invests $20,000 per year. That's double, just puts it in cash. Who comes out ahead? The one investing $20,000 per year. So savings is definitely important. The more you save, the better off you're going to be. Well, how much should a doctor save? Starting at age 35, if a doctor puts 15% of net family income into investing each year, usually by their early 60s, they'll be able to retire. What about 20%? Then retirement can come earlier, normally between age 55 and 60. These are just gross estimates, but from people I've talked to and the way investing works, that's worked out fairly well over the long term, as long as you're using buy and hold strategy without buying and selling. Buy and hold. Okay, passive investing versus active. I'd like to read a couple quotes here. First, Warren Buffett. Most investors, both institutional and individual, will find the best way to own common stocks is through an index fund that charges minimal fees. How about that? An index fund that charges minimal fees. Those following this path are sure to beat the net results after expenses and fees delivered by the great majority of investment professionals. In other words, simple index funds, buy and hold. From John Bogle, founder of Vanguard. The stock market is a giant distraction from the business of investing. Again, the stock market is a giant distraction from the business of investing. Buying and selling and trading doesn't work. Long-term buy and hold investing with low fees does, according to Bogle. Chris Gay remarked in a 2012 U.S. News Money article, the average equity investor underperformed the S&P 500 by an annualized 4.32% over the last 20 years. Interesting. As far as investing, whether you should be passive or active, passive works. Buy the whole market. Stocks, that's not just the S&P 500, which is large cap stocks, but small cap stocks, value, growth stocks, actually international also. International comprises more than 50% of the world market now. As far as bonds, treasuries we hear a lot about, but there's also corporate bonds, high yield bonds or junk bonds, and international bonds. Have a bit of everything. Let's talk about risk for a minute. Typically, risk is viewed by most individuals as percentage of stocks versus bonds, and that has a lot of validity. How much should you have? Depends on your risk level, but Jason Zweig and others have found, especially during 2008, that we have a lower risk tolerance than we think we do. Many back in 2008 who had a 50-50 mix of stocks and bonds and only lost 20%, not 40 to 50%, like those that were, say, in just the S&P 500. They bailed like the rest of them. So be careful of your risk level. Stay the course. Okay, active investing, sector rotation, trading, anything which involves getting in and out of the market or in and out of different types of investments is active investing. Please don't go there. It's a fool's game. Passive investing involves index funds and ETFs normally. Exchange traded funds or ETFs are a lot like index funds. The only real difference is that they can be traded during the day. Do we worry about that? No, not for long-term investing at all. One thing to be careful of is that ETFs have gotten involved in commodities and some really exotic trading over the last few years. You can buy an ETF in almost anything these days, whereas index funds, typically not the case. Be careful of ETFs. Okay, let's have a couple ways that an individual can invest fairly safely on their own. I'm going to bring up two different ways. First is called lazy portfolios. Paul Farrell on the internet has 8 lazy portfolios listed. There's more than that, but these are simple ones. Today I'm going to talk about one called Coffee House. Coffee House portfolio was devised by Bill Schultes, who's an author. He also has an investment firm. Bill is a pretty good guy. Bill has a very simple portfolio which is comprised of 1/3 Vanguard Total Stock Index funds. Again, that's 1/3 Vanguard Total Stock Index. 1/3 Vanguard Total Bond Index. Again, that's all sorts of bonds, corporate treasuries. The stocks are all sorts of different U.S. stocks, large, small, growth, value. And his third segment is 1/3 Vanguard Total International stocks from various countries throughout the world. That's done very, very well. From the period 2000 to 2010, that lost decade, it made 3 to 4% per year. Expenses for these funds average 0.10% per year, extremely low. The only thing that you as an investor need to do is to rebalance the fund, to bring it back to 1/3, 1/3, 1/3 every year. Why do you rebalance? It has to do with your risk level. Say in 2013 you started out with 50% stocks, 50% bonds. 2013 was a great year for stocks. So at the end of the year, maybe you were at 60-40, 60% stocks, 40% bonds, just because stocks had outperformed so much. To keep your risk level the same, you should sell some of your stocks, buy more bonds to get you back to the 50-50 level. That's called rebalancing, and it works long term. Another way for an individual to invest safely is target retirement funds or life cycle funds. A really good example is Vanguard's. They have different types of delineations of percentages of stocks and bonds for different age groups. It tends to get more conservative as you get older. They're comprised of total stock market funds, like we said with the lazy portfolios, a total stock fund, a total bond fund, total international stock fund, and a total international bond fund. They add one more to the mix, but it's very similar to Coffee House. Again, the mix changes over a period of time and gets more conservative as you approach retirement. The nice part about it is it automatically rebalances on its own and gets more conservative automatically. So you don't have to do anything at all, period. What's the expense ratio? It's 0.18% rather than 0.10%. So you're paying a little bit more, 0.08% more per year. Is that worth it to have it automatically rebalance so you don't have to change anything? I think maybe it is for two reasons. One, it's easy and you don't need to worry about rebalancing or marking it on your calendar. Number two, it tends to get you to look at your portfolio less. John Bogle's a huge proponent. I had a quote from him earlier about the distraction of the stock market. He says, don't look at your portfolio. Maybe once a year, maybe once every few months. That way you stay the course. Okay, another thing about index funds that I need to bring up is they are very tax efficient. They don't throw off much in the way of capital gains at all. So they can be used easily for both a tax deferred and a taxable account. Thanks so much for listening.